Attention A1 Trading Show fans. If you're interested in getting free access to the Edge Finder or our premium trade alerts, listen up. For a limited time, our show's partnered broker 8cap is giving out free access to our products when you sign up for a new trading account with them. If you already have a broker, you may want to consider switching to 8cap because of their low trading costs, a wide range of trading assets, and their amazing customer support. If you'd like to get access to our software and Discord server for free, click the link being dropped in the chat right now and ask one of our team members for more information. Don't miss your chance for free products and an award-winning broker. Now back to the A1 Trading Show.
All right. Good morning, guys. Welcome back to another live stream. Good to have you back here. A little quieter day today than it was yesterday, but we're back. We're doing our thing, and we got a lot to talk about. So yesterday, after the dust settled, what a crazy day it was. Stock market dropped a lot. You also had the VIX hit levels that it has not seen since like 2020. And I was looking at the VIX. Take a look at this weekly chart. If you take a look at the VIX has only made a move like the one we saw yesterday 2 other times in recent history. One was during 2020 and one was during 2008. And I thought this was kind of interesting and worth mentioning because the VIX, for newer traders who may not be familiar with the VIX, is an index that tracks volatility and expected, more likely future expected volatility in the financial markets, specifically the S&P 500. So the VIX is an interesting instrument to study because what the VIX tells us is that when you get these huge spikes, it means the market is very, very scared. And so yesterday you had a lot of fear come into this market. But what do we know about fear? Fear is typically a very good opportunity in markets if you are being responsible, trading, without margin, without taking huge gambles or risks. The VIX can be a lovely indicator of perhaps opportunities showing up in the market. So I'll show you something I thought was interesting. These 3 environments, 2008, 2020, and today, share a similar characteristic. The VIX spiked so fast during these times, then proceeded to do what? Proceeded to fall. Now, I'm not saying that the bottom of the VIX is in, or the top, of the VIX is in. We could theoretically see this thing shoot up and take out the highs. In fact, if we take a look at a weekly chart here and we zoom in a little bit what happened in 2020, you can actually see that the VIX shot up like this, and then it shot up again, and then it shot up again for a 3rd time before it finally started to truly come down. So with the VIX spiking the way it did in the last few days, you'll notice that we're doing something kind of similar. Big VIX move up, then we followed through again, then we followed through again. And the big question on everybody's mind today is, are we going to see another spike through the highs? But here's something I want to point out with this. Anytime the VIX has been doing this, historically speaking, it's not necessarily, an easy timing vehicle because, again, you may think the VIX has reached its top and then it just shoots up again and then shoots up again. But what we know is that when the VIX is getting at these levels, it usually doesn't stay there for very long. So when you get the VIX moving up, it means that a lot of fear has come into the markets. It means people are terrified. It means people don't know what's coming next and they, want to get into cash or they want to go short or they want to, they want to try and run and hide. But historically speaking, a VIX spiking dramatically like this is a pretty good time to take some calculated risk. And personally, that is what I am doing right now with a couple different charts. I've been mentioning that I've been trying to buy the indices, buying some areas of the market that I particularly like. And I'll say that for me, I've got a game plan that I wanted to share a little bit with you guys today on how I'll be treating this correction potentially forming in the financial markets. So I'll go through my game plan with you guys because this is not going to be if you watch my show, regularly, my streams and my videos and stuff, I'm not a day trader. I'm more of a swing trader. And so when I see these big spikes lower in the stock market's getting really emotional, I start getting excited. In fact, I would like if the market pushes lower. Even though I have some long positions in the market right now, the ideal situation, if 6 months from now the market is higher, and I'm talking specifically about like the S&P 500 guys. So if in the next couple months we see the market dip, this would be ideal for me in the longer run. Personally, I'll tell you why. The reason is because in my personal, kind of financial situation, I'm sitting on some cash, meaning I have room to continue buying the dip. And I want to point this out because some people are going to, see me if this happens, they're going to say, "Nick, you have just been horrible with your timing." But stock market crashes are very hard to time a bottom. And the purpose of me sort of scaling into this idea is that I am definitely not trying to call a bottom. In fact, why would I like the market to take out this low and stop me out on this position before going higher? Well, because if it does, I have a personal rule. And this is a way that, I think everybody should have their own rules, but here's one of mine. I don't like to dollar cost average or just buy the stock market when it feels expensive. I have not been adding to my stock account. I've not been adding to my trading portfolio for some time. But I do add to my portfolio during sell-offs. I added to my portfolio and ended up being a very wise decision in late 2023. I added tremendously to my portfolio in 2022. I add to my account during down months and years. So I have a game plan mapped out personally on how I'm going to be treating the sell-off in stocks. And I've mapped it out on VOO. These white levels are areas at which point I will be adding to my trading account balance. Why would I be adding to my trading account balance? Well, first of all, I have cash sitting on the sidelines in my personal life. I don't trade, 100% of my money at any point in the market. I have cash on the sidelines. If we see the stock market roll over, then I think you start getting some really advantageous pricing on some of the companies that I really like for the longer term, as well as some good dip buying opportunities on the indices. So I am bullish overall. I think that, if 5 years from now, I'm buying this whole way down, I think I'll be really happy that I did that. So just wanted to give you guys my thought process. Everybody gets all fearful. They get terrified during a time like this. They see the VIX spiking up and people start making really, kind of rash decisions. But in my view, take this as a good thing. It is an opportunity. If especially you're somebody who is, looking to maybe make a, longer term buys of certain things that you like, this can be a really great opportunity to add to those companies that you like, or perhaps, maybe even you see a big dip in gold. If you're somebody who likes gold for the longer term, think about it as an opportunity. Don't think about it as a fear event, right? Don't get caught up in all the fear. You're going to have plenty of that all over the place. People are, terrified during market environments like this. I actually, as much as I am, I'm long, I have some positions I would like to go up. The ideal situation for me is actually the market to continue going down so that I can start adding and building at much better prices into companies that I like and buying indices at lower prices. So just wanted to give that message because I know a lot of people are, watching this market and they're terrified. Oh my gosh, it's going to crash, and just something to think about. Anyways, let's also take a look at gold here this morning. So gold came down, tapped into this 2360 level. I mentioned that I like this area for a possible buy. So if we see gold roll over, same thing applies. I am bullish on gold overall. And so dips into 2360 or 2300, in my view, are opportunities. So I'll be watching those closely to see if we can get a little bit more sell-off in the price of gold. Again, I want to kind of phrase it as this. I am looking forward to a bigger dip in markets. That would give you opportunities if you're, liquid enough, if you're not, over leveraging your account or being irresponsible. It gives those types of people a great opportunity to build positions and things at lower prices. It's kind of dollar cost averaging. Yeah, it kind of is, Steve. And the thing is, I would say that for my personal approach to markets, I like to dollar cost average, but in a different way. I don't just buy and hold. I am looking to, add only when I think that the stock market or markets in general are looking a little bit like a good deal, right? I don't like to buy the market just for the sake of buying the market. I like to buy the market when I feel like it's giving me a better deal. And so when we take a look at, the S&P 500 and you say, well, let's take a look at this moving average, we're not quite there, but I'd like to buy that 200-day moving average, and I'd like to buy lower if I can, as long as I can get a price action signal. So if we see something like this, big slide to the downside, I may be able to deposit more. And then if we start seeing higher lows, higher highs form, then I could feel like I'm getting a really good deal and may be able to catch the upswing if it starts to form. So something to think about. What about seasonality? You're buying in summer months? Yeah, let's take a look. So seasonality, good point. Let's take a look at the month of the year trends. And August, let's take a look at, by the way, gold, historically a pretty good month for August, or for gold. August is historically, in the last 10 years, a pretty good month for gold. Let's take a look at the S&P 500. So take a look at the S&P 500. August is expected to be a 1% gain. So obviously, first couple of days of August have been really rough, but on a longer term 10-year historical average, the S&P 500 has averaged about a 1% gain in the month of August. September is the worst historical month of the year, going back for many years. Obviously, we've got the 10-year calculation here, but I believe going back as far as 40 years, the S&P 500 has averaged a flat or negative gain. Now, of course, over the very long term, stocks tend to go up, but in the short run, they can be very, very volatile, as we've seen, again, with the NASDAQ dropping like 6% the other day. I mean, crazy stuff. So volatility, that's why they call it shorting, right? If you're short the market, a lot of people would consider it like a short-term bet against the market. And obviously, if you've been short, then you've been making a lot of money during this past couple of weeks. But anyways, so, in terms of seasonality, the old adage, sell in May and go away, has actually been a really bad strategy for the last 10 years. If you sold in May and walked away from stocks in the last 10 years, you missed out on some of the best gains of the year. Take a look. May positive, June positive, July up 2% on average for the S&P, up 1% in August. I mean, that's a historically meaningful period of strength for the stock market is during the summer months. So yeah. Take a look at the top setups page for the day. Let's take a look of take out our neutral readings for a moment. We've got gold still up here. You got the S&P and Dow giving slight bullish readings. Gold, I am looking for opportunities if we do see a bigger dip. TLT or 10-year treasury bonds. I timed this one terribly. We got right out of TLT at the worst possible time, guys. I don't know if you've been watching me, then I got out of TLT on this pop and then it just shot way higher. So feeling a little bad about TLT, but you're not going to play it perfectly, especially during these very volatile times. It's been rough. The Russell's taking a little bit of a beating here. I actually have a long position on the Russell, so let's see if that one can bounce back. The NASDAQ holding its own, and I'm curious about semiconductors specifically. Semiconductors up 1.66%. How's NVIDIA holding up today? NVIDIA's up 3%. Very nice. S&P just about flat on the day. And I wanted to mention something, guys. I added the Japanese stock market to my watch list here, JP225, just to keep an eye on the Nikkei, which many would contribute a lot of this recent sell-off to what's going on in Japan. And a lot of people are saying a lot of different things about what's going on in the markets. Some people are pointing and saying, oh my gosh, the stock market is selling off because the presidential election is uncertain. And other people are saying it's because there's war in the Middle East. And other people are saying it's because the economy is falling apart. And other people are saying it's because Japan's, the carry trade unwind is a terrifying thing. And I would say it's probably a little bit of everything. It's hard to pinpoint exactly which thing it is. But let's take a look at one of the most, in my view, perhaps the most convincing ones, which is the carry trade unwind, or the fear of it being a bigger unwind. Take a look at the weekly chart on the Japanese yen against the US dollar. So the US dollar against the Japanese yen has been trending up for a number of years. And just recently, we saw a big fear event with the jobs data out of the US coming in very weak, people getting very afraid, investors flocking back to the yen, meaning selling their dollars back and buying back yen. Why is this going on? Well, the kind of high level or simple answer to why this is happening is because a lot of investors, a lot of fund managers, a lot of just activity borrows money from Japan because they offer very low interest rates. So if you wanted to borrow money, you could go borrow money from Japan, from the Bank of Japan, for a very low interest rate. Now, the reason that that matters is that a lot of people have been doing that. They've been selling yen and buying dollars so they can go buy US stocks, they can buy real estate, business investments, they can buy US dollars, buy bonds, whatever they want to buy, stocks, whatever it is. So then when a fear event starts to happen and people start to get nervous about the economy, oh my gosh, the world's going to fall apart, people have done the opposite. They've sold their dollars, they've sold their stocks, their bonds, they're going back and they're paying back what they owe to the Bank of Japan, which is in yen. So they're buying the yen. Right. So the yen's been a big mover here in the last few days and weeks. And I think that this has been a large part of the story as to why the market has seen so much volatility. Again, NASDAQ down another 0.5% today, but it's been just getting killed recently. And again, these are normal kinds of moves, but the move has been very aggressive, very quick. You know, this sort of percentage drawdown on the S&P 500 is pretty normal. We're down 8% from the highs, 10% at the worst case. Very well could take out those lows and keep going. And if it does, I mentioned at the top of the stream, that's ideal for me because personally, I'm going to be starting to build bigger positions by depositing more money to my account. So I mentioned at the top of the show, a lot of people, when they trade or they invest, they add to their accounts over time. I do the same, but I generally only add to my account when the market feels like it's a good discounted buy. So because of mostly I trade indices and things like that, I like to add more size to my account during dips, right? So when the market is going lower, those are times in which I like to build positions, meaning not build positions, I mean add to the account. So if we do see, you know, another event like July to October, this was, you know, really good loading the boat opportunity before this bigger push that we saw in the S&P 500. 2022 was rough. It was very big downside move, but ultimately it was a really good buying opportunity if you could wait and be patient for, you know, signs of a bottom on the market. So we'll see. I think that there are some signs that we may be bottoming out on the S&P 500. We've got some support levels that are trying to hold here, but if they fail out, again, not the end of the world, actually more of an opportunity. I think the lower stocks go, the more opportunity we have here for a possible bigger buy the dip opportunity. That's my personal take. Don't do what I'm doing. Just do your own thing. I'm here to share my own personal opinions. I'm not here giving you financial advice. So anyways, I did also want to mention we are offering a free Telegram channel. If you're not in our Telegram, link has just been dropped in the chat. We'll be sharing ideas throughout the week on setups, ideas, things that we're looking out for. So we'll be covering things like the yen. We'll look at gold. Speaking of gold, let's talk a little bit about gold. So if we see a bigger dip, this would be awesome to get some gold at a lower price. And if this happens, if we see the bigger sell-off, perhaps 2350 is a nice level for me to try and buy some gold. And if that doesn't work, right, 2300 is another level I would try. So I speak a lot about this when I'm taking entries on the markets. I know that, you know, traditional, you know, trading guru stuff is like to kind of always be like, oh, I got sniper entries. I never miss. I miss often, but it doesn't matter because at the end of the day, if you're managing risk appropriately, then your strategy overall is a good strategy. You're going to have ups and downs, ebbs and flows, but the longer term is all that matters. You know, I look at my account, I say, I'm not looking to make gains here in the next 3 weeks. I'm looking to make gains over the next 10 years. I'm here for the long term. So I view these times as really good opportunities. And I would encourage other people to think about it in a similar way. Don't let the fear completely control you. Because again, volatility can be very blinding for a lot of traders. They start getting overwhelmed. They change their strategy drastically. Again, doesn't matter which strategy you pick. There's going to be good moments for that strategy and there's going to be bad moments for that strategy. But again, to me, this seems like a possible opportunity that is forming. So let's see if we can get some lower prices on things like gold, the S&P 500, the NASDAQ, etc. But again, gold for me, why am I bullish on gold? Well, let's break this down for a second on the Edge Finder. Gold is giving us a bullish reading. Seasonally, we talked about that earlier. Seasonally, it's a pretty bullish time of year for gold on a 10-year historical average basis. The trend is still tentatively to the upside on the daily chart. GDP has come out and beat expectations, so that's not particularly good for gold. PMIs, in fact, let's go do this on the data scanner page. So I'm going to go to the gold data scanner page on the Edge Finder. This is our full feature list. So this is all the different economic data points that are being studied by the Edge Finder's internal algorithm. So let's go through this. So commitment of traders data is flat. Why is it a mixed reading for us? Well, I'll show you. Institutional money is very long gold, but in the latest filing, the weekly change was very bearish. So let's go ahead and call that neutral. So that's why the score is 0. And hopefully by doing these breakdowns, you'll understand kind of how this tool functions, what the purpose behind it is. So retail sentiment works against us because retail sentiment is showing retail traders are very long gold right now. So that's not necessarily a great signal. That gives us a -1. Why? Because retail traders, unfortunately, they're very emotional. They're trading with, they're fighting trends aggressively. So this move lower, retail traders are piling into a long. So that could indicate maybe we have some short-term lower prices to come for gold. Let's keep going. Seasonality. This month on a 10-year historical average performance is a gain of 0.92%. So that's telling you that if August subscribes to standard seasonality, we would expect a modest gain for gold on the month. Let's keep going. Trend to the upside. We saw that on the daily chart. Overall upward trend. GDP. Why is GDP giving us a bearish reading? Well, let's go take a look. Under economic growth, let's go to what the forecast was. Forecast was for 2% GDP growth for the US. We actually saw 2.8. That's better than expected. 0.8% beat is not good for gold. Because remember, gold thrives in an environment where the economy is falling apart and people are terrified. So GDP beat expectations. So that gives us a -1 on gold. But let's keep going. Manufacturing PMI came in really light. So manufacturing PMI came in lighter than expected. And then if we take a look at, this seems wrong. I need to check this. This is actually incorrect. Our services PMI forecast was not 53.8. I think it was lower than that. Or maybe the latest data point hasn't updated. This is wrong. This actually should be services beat expectations. So this should actually be a -1 for gold. So that is an issue on our end. We will get that sorted out. Retail sales. Retail sales is, of course, like consumer spending sort of ideas. It came in higher than expected. That is a bearish signal for gold. Now what we'll see is there's a lot of positive signals for gold. Let's take a look at these. Inflation. Well, inflation is giving us a positive reading because inflation has been coming down relative to forecasts. Again, inflation coming down is showing that the Fed is likely to cut interest rates aggressively. And recently that's become very apparent. So that's bullish for gold. So we get 2 points there. Finally, we've got employment data and interest rates. Unemployment rate went up by a surprise of 0.2%. That is very bullish for gold. Then you take a look at the labor data statistics, and we missed jobs by a good margin, gives us another point. So finally, interest rates are coming down on the 2-year Treasury yield. We see them trending lower. It gives us another point. I hope this makes sense on how we scored the Edge Finder's algorithm. I hope this was a good breakdown. If you liked that, do me a big favor, just hit the thumbs up button on the stream. I appreciate it. If you like that sort of coverage of how the Edge Finder functions, the systematic, behind the scenes of it. I never really know if people want to see that or hear that, or if that is too in depth. But I do like to go through it myself. I find it to be very valuable to walk through it. So I'll do it periodically, especially when we talk about gold, which a lot of people in the audience are very, interested in that. What's the difference between your Discord channel and your Telegram channel? There's no difference. We put the same content in each one, but some people prefer Telegram, other people prefer Discord, and my team puts out content on both. Same content, just 2 different places. So totally up to you where you want to be. Also, if you're interested in the Edge Finder, I got 2 things for you. Number 1, we just dropped a link to producers have so kindly dropped the link there for us to try out the Edge Finder. If you want 30 days access to it, apply using that link. And also, I got one other thing for us. We got to promote this. Hold on. Okay, here it is. Copy link. Chandler and James, if you guys want to copy and save this somewhere yourself, this right here is something also kind of fun that we should push today, which is the 8-cap Edge Finder free competition. So we're doing something kind of fun here. If you're somebody who would like to win a free copy of the Edge Finder, we are doing a competition with 8-cap coming up soon. It is free to join. It's no strings attached. You just can join the competition. It's a demo account competition with 8-cap. And the winners, the top 3 performers, actually get to, there's some like free stuff that you get. The winner gets an Edge Finder Pro, and I think the second and third place get an Edge Finder Basic. Correct me if I'm wrong, but all the information is on that link. If you click this link, you can sign up and get some information about the competition that we're doing. Again, it's totally free to join, and you have a chance to win an Edge Finder copy. So why not take advantage? Totally free to join. So yeah, don't miss out on that for sure. We just launched that, so it should be kind of fun. All right, so stocks here down 0.24%. Haven't really moved too much. NASDAQ down 0.6. Dow is down 0.1. The Russell down 0.6. And here's the thing for the indices, right? If you take a look at the S&P 500, this is kind of our line in the sand. If we can't hold this low, then obviously a new low is forming. But it is possible that if you can't hold that low, the S&P 500 very well may go back and test 5,000, which, again, as I mentioned at the top of the stream, I would view as a really good buying opportunity, because I think you're starting to get good prices on the indices. I think you're starting to see opportunities here that could be very, very nice buy the dip chances. So I'm watching them close. I do have buys already in, but I'm very prepared to buy the dip more aggressively if it does come down further. And I mentioned also my game plan in case you're just joining into the stream. I marked this out on VOO. If we continue to see a dip in the stock market, these levels that I've got are points at which point I'm not buying the stock market at these levels, but I would be depositing. So D for depositing. I'll be adding to my account. And I do this purposefully. Everyone who, trades or invests, you have the choice of when you actually deposit to your account. And because I trade indices and gold so heavily, I like to get them at discounts. If I can be patient enough to wait for good prices on these things, I purposefully keep cash on the sidelines in my personal finances for times like this. So when we see the stock market selling off a cliff, that to me is one big opportunity to start depositing and actually finding creative ways. I'm still adding my trading dynamics. I'm adding, waiting for good, proper setups with good risk management, but I'm looking for opportunities to deposit to the account, build bigger positions for the longer term. And I like to add to the account when the stock market is actually seeing some better prices. And I think we finally might be starting to see, a proper dip. So here's the VOO, the S&P 500 on a 200-day moving average. Again, has room to come down. If it comes down to those levels, I very much like the idea of, getting it at better prices. So it's kind of weird. Like I have some positions. I think that we could see a bounce from here. Even if it's short term, I think we might see some form of a bigger bounce from where we currently sit on the daily chart. But if we see this thing roll over, then the dips get even, in my view, more attractive. The sky is falling, and that is exactly why you look for good opportunities. A lot of people during these sorts of times will lose their principles, they'll lose their strategy, they'll lose sight of the long-term vision, and they will let, the fear completely control them. And a lot of people are going to get here's the other thing. A lot of people will make the mistake of getting uber bearish and start like betting heavily that the market's going to keep going lower. And it could, if you're somebody who's betting against gold, there is possibly more room for this thing to trend lower, make a move down to like 2360. In fact, I think it's probably going to go back and retest this. We'll see. And if that happens, there might be a nice little opportunity to pick up some gold at better prices. And if it breaks that level, again, I mentioned this earlier, 2000 starts to look really good too. I have a bullish reading on gold for currently, as we just broke down on the Edge Finder. I prefer the long side at this current, position with such a good score. If this flips bearish, then I may start to get short on gold. But for now, if we're holding up a decent reading on the Edge Finder for gold and we're getting a dip, very, very interesting. How does the seasonality work? Good question. So seasonality basically takes the historical performance of an asset over years and years of data. So if we take a look at the month of year trends, we take a look at currently the one selected is the S&P 500. All it's saying is that in the last 10 years, during the month of August, the 10-year historical average has been a 1% gain. It was 2% in July. Now, please understand when I go through data points like this is not a certainty. You can see there are times where seasonality is just wrong. Like in April, where we had a 4% drop in the S&P 500, but the expected return was 0.28%. So the market was expected to be flat or slightly positive. It came in very negative. And that could happen again in August. In fact, if we look at September is actually a historically bearish month. So we'll see. In fact, if last year was one of my best buy the dip opportunities that I've had in a long time. During these 3 months last year, August, September, October, the market just sold and sold and sold. And then it ended up being a really good buy the dip chance. Caught some breakouts once the chart started moving back up again. And that was a really strong rip. Some of you guys might even remember, some of you might have been watching the channel during that period of time where we caught that seasonal shift in November and December, and it played out perfectly last year. Will it happen again? Maybe. Seasonality is not a guarantee. You have to be careful. Nothing is guaranteed in the markets, but seasonality is a nice indicator to add to your analysis. S&P 500 still just flat on the day, NASDAQ flat. But I will say this, as you get this big dip in equities globally, Japanese stock market, the VIX popping up, the burden from here with a big sell-off like this is sellers have to continue this trajectory. They have to continue this speedy sell. Otherwise we've got issues for the sellers. Here's what I'm trying to get at. Okay, if you're somebody who's looking at this chart and you're a bear, right? If this thing just goes sideways, because suddenly dip buyers are going to say, well, why aren't the sellers continuing the push? And what does the market typically do? Typically drifts up. Not always, but it typically drifts up. So if you're a bear, you're probably looking for follow through quick. I mean, if I'm bearish right now, and I'm not, but if I was bearish, what I'm looking for is just give me that flush through the lows pretty quick. Otherwise, I need to take profits or get out of the trades, because follow through is really important for bearishness, because stock market typically moves like this. Very slow upward gains. I mean, we're seeing it directly on our charts right now. Slow, gradual uptrends, rapid downtrends. If you catch one of these moves, you can make a lot of money, right? If you're short during a time like this, absolutely you can make a lot of money. But to me, the burden right now is on the bears to prove it that we shouldn't just bounce from here. Why shouldn't the market, with such good companies, such dominant, the ginormous companies that lead this stock market, why shouldn't people go in and buy the dip if Japan is stabilizing, right? Remember, I think Japan was the trigger to this global sell-off. But Japan bottomed out, rallied back overnight, guys, 13% from the lows, 14% from the lows. I'm not saying this is the bottom for sure, but you do have to consider that sellers need to follow through in the coming days, or we may have found a bottom. That's my thought. So I just want to reiterate with my personal approach during this time, I am viewing this as an opportunity. I have long positions in, but if this market rolls over, it is best case scenario for me, as confusing as that may sound, because I'm looking to deposit more into my accounts if the market becomes cheaper. Does that make sense? If you guys are on the same wavelength or understand what I'm getting at, do me a big favor, type yes in the chat. If you're on the same page, yes is in the chat, thumbs up, yes, why, whatever you want to put, just let me know that makes sense. I'm trying not to be confusing with that because I know people are saying you're long, but you want it to go lower. I kind of do, because in the long term, that would be certainly the best case scenario for me. Because in the long term, I'm bullish in the market. And if I'm right about the long term, the market's not falling into Never Land. If it does, then I'll just buy the way down and I'll keep adding and be constructive with it and manage my risk. But I'm not on margin. I'm not leveraged. I'm trading reasonable size. And this could be a nice buy the dip opportunity. Even if we see a 20% correction in the S&P 500, that's best case scenario. Let's understand something, guys. If you are bullish, please understand this. If you are bullish, but you have free cash on the sidelines, or you just have in general patience to wait for good prices, if you get something like a 25% sell-off in the stock market, do you know how much of a blessing that actually is in the long run? It's huge. Don't let, again, a lot of people will say, here's what people have always said throughout time. When the stock market starts selling off, they say this thing's going to nothing. Then when it starts going lower and they're right, they're like, haha, see? And then they say, but I'm not going to buy it yet because it's going to go much lower. And then if it doesn't go lower, they just say, oh, this thing's a scam. It's overbought. I'm going to wait for it to go back down. Then once it starts going back down, what do? They say, oh, this thing's going much lower. And then it goes higher again, right? In the long run, stock market's designed to go up because big companies grow. The populations of the world grow. GDP of countries grow. Stock markets grow over time. But please don't mistake that for stocks only go up, because they certainly do not. And when they drop very precipitously and aggressively. But if you're patient and you have the appropriate risk management during times like this, you're looking at opportunities, not devastation. Unless you're leveraged. If you're leveraged, best of luck to you. But I personally stay far away from leverage. And I think that is, what keeps you in the game long term. How's the U.S. stock market performing today? Well, if you take a look, the S&P 500 is up 0.24%. Not a big move, but it looks like we may be trying to find a bottom. We had a huge rally off of those lows. We're trying to hold the lows. But again, as I keep mentioning, if we go back and take out those lows, it's very possible that we could actually see 5,000 get tagged and the sellers could kind of take over again. And perhaps if that level breaks, then you're really looking at maybe we're going to see a real, possible even bear market environment for the stock market. But we'll see. I think, you kind of have to, in my personal view, you have to assume this thing is innocent until proven guilty, because this thing has been a monster. And this dip, in my view, I'm going to be buying this dip until proven otherwise. Another area that I've got a small position on is the Russell, which the Russell, I've got long positions on IWM, which is an ETF that tracks the Russell 2000 index. So the Russell 2000 index is an interesting one. It's smaller and mid-sized companies in the United States. These companies have been really not doing very well in the last few years. Take a look at the Russell 2000. If you had bought and held this thing since 2021, you're about flat on your entire investment during a 1,300-day period. This is personally why I'm not a big advocate for just buy and hold. I know that's for people who are not interested in putting in the work of trading, buy and hold is great. But for traders, I mean, to make 0% in 1,300 days is, not fun. That being said, I do think that this thing, if we look forward, has room to continue to go higher. The reason for that is because if you're taking a look at the rate cut situation. Let's take a look at some data for a second. If we take a look at where interest rates are expected to go, well, inflation has been coming down, came down a lot, went sideways, and is starting to come down. I expect that with the recent slowdown in the economy, we're probably going to see inflation come down further. The question, though, about whether you want to buy the Russell or not is all about this. Is the economy okay? Because if the economy is not okay, if you've got serious problems in the economy, then my trade on the Russell might be really early and might be a bad one. But if the economy is not falling apart, and there's some things I would point to that suggest that it's not falling apart just yet, like, for example, services PMI yesterday, I think we didn't get our latest. We got to check this. This services PMI is missing from yesterday. Anyways, services PMI came in and it beat estimates yesterday, just slightly. And that might have saved the day for the stock market because people are terrified about the recession possibilities. Is the world going to fall apart? The economy? Well, GDP beat estimations by a wide margin, 2.8%. And the Atlanta GDP now, the Atlanta Fed's GDP now, which has been a pretty dang accurate indicator of GDP. They're like the best in the business, I would say, for trying to predict growth in the U.S. economy. Still is projecting 2.5% growth. That's nothing to scoff at for U.S. economic growth. Not to mention, if you're going to see a recession, do you guys remember that the technical definition for a recession is 2 consecutive negative GDP growths? So if you think that the market is going into a major recession, it could, but again, the bears have got to prove that because the U.S. economic growth has been very strong. So again, if you are somebody who is just uber bearish on the market, we've got to see GDP growth go negative. You've got to see, labor data fall apart. You've got to see inflation, go down dramatically because of lack of demand, lack of growth. And again, I'm not saying it can't happen, but I'm looking at the data in front of me and I'm saying, I don't quite see it. Now, if you want to get bearish, you could point to retail sales and you could say, well, look, the consumer is not spending more. They're hurting. Inflation has really robbed them of their savings. And that is kind of true. But net household incomes, which we don't have in the Edge Finder, are up. We see people who, have benefited from the rally in stocks in the last few years. House values are up a lot, so people are feeling a little bit wealthier. What's kind of weird is that here's another company. I get that people are concerned about a recession, but here's AXP. This is American Express. American Express doesn't seem like it's going into recession. Their earnings have been phenomenal. They're making money. They did miss on their revenue the last time around, but they're not falling apart. Now, if you want to get bearish, here's UPS. UPS, terrible earnings. That's the economy. That's concerning. Don't get me wrong. There are signs of a slowing economy. But my point is this, and why I'm still bullish is I say, well, yes, there are signs of things cooling off. That's what we needed to see for rate cuts. And with the rate cuts that are expected to show up in September, here's what I think would be best case scenario. If you want the market to go up, if you're bullish, right? Chris, we'll be on 10 minutes. Okay, cool. Oh, sweet. So check this out. If you want the market to go up, here's one thing we don't want to see. An emergency cut. Please don't do that. So yesterday, we saw a lot of people get all like, oh my gosh, the Fed's going to cut rates in an emergency meeting or announce that. That to me may sound like a decent idea, but can you imagine the absolute fear of Jerome Powell on that fabled Wednesday where he came up and said, we think we've done it. We think we've got inflation cooling, labor data cooling. We think we're going to be able to cut rates and get away with this. basically, is what he was saying. I'm paraphrasing heavily, but he says that. Can you imagine if a couple days later he comes out and says, actually, we're going to emergency rate cut? Market would hate that. So let's not do that. And I don't think the Fed's going to do that. It was all over my feed, people saying the Fed's going to need to emergency rate cut to stop this thing from selling off. I don't think so. And I think that that would be bad, because if you saw a Fed rate cut, it would look irresponsible. It would look like the Fed is admitting that they were wrong, and that would not look good. Now, is the Fed wrong? Is the Fed too late? Maybe. But again, we just went through a list of economic indicators that are not showing, the worst thing ever. Company earnings hanging in there for the most part. Retail sales not particularly great, but services PMI beat yesterday. GDP growth beat. We still added jobs, right? I saw somebody talking about, here's one thing I wanted to discuss. And I don't know how much truth there is to this, so maybe somebody can look into this and share it with us, share it with the class. I've heard that a lot of the concerns around this last jobless claims statistic that came in were a little bit skewed by the hurricane that is happening in Atlanta's southeast, right? I'm sorry, Atlanta, America's southeast, right? Florida. The hurricane in the Gulf. Supposedly, and I don't have any facts in front of me. I've just heard people talking about this. The possibility that this could be skewed a little bit higher than what is actually, normal because of the hurricane situation. I've also heard people are coming back to work in waves, and that is causing a little bit of more joblessness or unemployment claims. And then finally, the 114,000 jobs, is that a bad number? Yeah, it's a bad number compared to recent history. But over long-term history, it's not like a devastating number. We still added. So I just don't see why I currently don't have a reason not to be looking for dip buying opportunities. That's the way I see this. And that was my long story short presentation that I want to share with you guys. I am long. I've mentioned, however, and I'll just reiterate for people who may be joining just now, I outlined this on my VOO chart. If the market rolls over, it is best case scenario for me in the long run. And I imagine for many of you, it also is as well. What I mean by that is that if you are under 60 years old, right, this is a good thing. As weird and scary as it may feel in the short term, oh my gosh, the market's going to crash, falling apart. It's a great thing in the long run to see lower prices on equities and to get your chance to get them at decent prices. So let's hope, as much as I am bullish right now, let's hope I'm wrong, and let's hope the market rolls over further so that prices can become cheaper. I just want to reiterate, none of this is financial advice. This is my personal plan. And if this thing gives me a drawdown of 50% in my account, hey, my account is a long-term growth account. I signed up for that. I signed up for the steep drawdowns with stocks. If you don't want drawdowns, if you don't want struggle, if you don't want anything hard, stay in a money market account and stop trading. Point blank, period. That's like, what everybody I think needs to hear. If you can't handle the volatility during times like this, that's fine, but stay out of the markets. Anyways, yeah, that's kind of my presentation here. Stock market's up 0.6% today. We'll see if this thing wants to bottom. I am not a believer until it really shows, a solid couple days up. We know with stock market sell-offs, they can be suddenly, the bears could come in full swing by this afternoon. We'll see. And again, going back to my bigger picture plan, I kind of hope it happens because then I can get lower prices. Anyways, with that said, we're going to take a quick break and we're going to bring in some heavy weapons here to help us out with this crazy volatility we've been seeing. We got Chris Pulver joining the show in just a moment. Before we bring him on, we're just going to take a short break and we're going to hear from one of our sponsors that makes this show possible. Please take a second to listen to our sponsor, and then we will be right back with Chris just after this. If you're someone in the United States looking for a Forex broker, it's been hard to find recently. There's been a lot of changes in the industry, so I wanted to take a moment to tell you guys about Oanda. Oanda is a US regulated brokerage that allows US traders to trade currency pairs like the euro dollar, the pound dollar, the dollar yen, Kiwi yen, all sorts of different currency pairs. So if you're interested in checking out Oanda, we're going to be dropping a link in the chat right now as we speak. They, again, are a huge brokerage in the United States that allows you to trade without the worry of whether or not your account is going to get shut down tomorrow from an offshore, unregulated, sketchy brokerage. They have been around for a long time, and I've used them myself for a number of years. So if you're looking to trade FX and you're in the US, this is the brokerage to check out in my personal opinion. So take a look at it. We'll drop the link in the chat, like I mentioned, should also be in the description of this live stream. Do your due diligence and see if it's right for you. Now back to the show. Chris, you're back. How's it going, man?
Good. Just wrapped up a trading battle session, so had to dive into the markets a little bit. I was hosting, so just uncovered some interesting very short-term trading for the guests that they had today. They had James Bruce and a gentleman that goes by one name named Hunter. He's a founder of Maven, a prop firm. So, and it was fun, but very short-term dude, like talking, hey, I trade for 15 minutes a day.
Wow.
So it's funny. I'm like, I think I'm probably twice as old as both of those guys. But
well,
I don't look it.
No, you don't, and you're not twice as old and Hunter. I think he's probably about the same age as me.
Okay.
So you're not that old.
Yeah.
Don't worry about it, Chris. You'll be
All
okay.
right.
Anyways, speaking of being okay, market here seems to be trying to find a bottom. I just gave a long presentation on why I am bullish, but would like to be wrong in the long run. And I know that this is picky, and I'm being, specific to people who have cash on the sidelines. If you're fully invested, you don't want the market to go lower.
Correct.
But if you're not and you have cash on the sidelines, a bigger dip could be an opportunity. Reason I wanted to share that thought with people today is because I think it's important to remain steady, calm, and diligent during a time like this, because it is very easy to lose your morals, to lose your discipline during a time like this where volatility expands. You know what I mean?
Yeah. Look, yesterday was not easy for anybody. I don't know. I know some very, very good traders that lost a lot of money yesterday, and did it mechanically. The hardest thing for me, and you and I talked about this offline, but look, I had stop losses in place for some of my trades that were blown through, meaning I put this is an important lesson: limit stop losses, not market stop losses.
Yep.
Okay. I never appreciated the importance of that for the last 5 years until yesterday, because especially in the futures market, if you were to get the bid price or the ask price, mostly the bid if you're closing out for selling options or selling future options, if you got the bid price yesterday, what should have been a spot of maybe, let's say I get a trade for $10 credit and my stop loss is $30 debit, so I'm going to take like that 200% loss or 300% loss. The market would have put it in yesterday. The bid price would have been maybe 100, maybe 150. It would have been like a 10 to 15x loss if I just had a market when it was filled at open bell. So I took a bit of a risk yesterday where I let some of my P&L fluctuate and float. And so I'm not going to lie, man, like things looked pretty crappy yesterday. And I'm not saying they can't turn crappy, but what I did put on yesterday as I was actively trading through it Sunday to Monday was a lot more hedges just in case I'm going to let these P&L fluctuations happen.
Yeah. Well, and the thing is, Chris, I was kind of given this rant too about thinking about, if you're somebody who you have to ask, we're not financial advisors here. We're not here telling individuals what they should do in their account. But one thing you should be thinking about at home is, what are your personal objectives? If you're somebody who's like, I'm trading to make gains for my long-term future, then again, you got to be ready for bigger swings like this, especially if you're taking larger, risk, if you're, employing any sort of, trying to trade more aggressive things, like if you're trading tech, or if you trade, it's not your standard buy SPY and hold it. If you're trading, you kind of accept bigger swings both up and down. So one thing I wanted to point out too today, Chris, is this turnaround of the VIX is aggressive. We've got VIX down 27%. But here's the thing. I was looking at this, and again, I'm not saying I think this is what's going to happen, but we had environments like this back in 2020. Now, 2020 is so unique because it was such a peculiar kind of market where we saw the global shutdown due to a pandemic. But we did see these big shoots up in the VIX, followed by aggressive sells. Then it would renew again. Then it would come back down. Then it would renew again. And if we do one more test, if we go back to 2008, which is the real deal, similar concept. You had these big explosive VIX moves. People get kind of back into being bullish, and then it shoots up again. So here's a question for you. Is this, bounce back? Do you trust the bounce back? Are you positioning for a bigger move higher across the indices? Or are you playing it more like I'm going to take profits where I can pretty quick in anticipation for possible renewed VIX energy to the upside? What do you think?
Well, I think what was really revealing yesterday is it was essentially just a 1-day vol event that was built up over weeks and weeks and weeks of waiting. Think about how the market topped over in July when we had 6 all-time highs in 6 trading days, and then finally started to peak and topple over. So that it's right there. It's right there. It's right there. Look, we've been talking about this all year. Low volatility, historically low volatility. That is a problem because the market finds a way of delivering, maybe once a year, maybe every couple of years. But I mean, you just mentioned some of the biggest. I mean, this was the second largest vol event in a single day that we have ever had since 1990 in the VIX. Like,
Yep.
that is something to remember. It was one of the. I'm trying to think what else statistic wise we had. One of the bigger. Hang on, I've got some interesting factoids here from yesterday. Let's see here. I mean, 90% of the market was down yesterday. The somebody had mentioned if CNBC comes on today and says markets in turmoil, that's typically a nice contrarian indicator. You guys might want to throw that in for the Edge Finder when you're Bloomberg's and CNBC's are like markets are red. It's like usually it's a great thing to buy the book.
Yeah, right. Yeah, that's so true.
So anyway, my point is with the VIX. I mean, I don't think we're all of a sudden going back to 12. Okay, I think we'll do it. I mean, I'm looking at the VIX the term structure here. I think that we will probably stay in the 20s, which is higher elevated volatility. I mean, if you have a 25% VIX, okay, or I should say it's more like a 25.9 move. Look, if you're getting the S&P to move 1/4 to 0.5% a day, that's a decent move. I mean, a lot of times the market's essentially zero sum. There's ups, there's downs, but it goes very little from a day-to-day gain. And so if we're getting like 0.5% moves, 1% moves every single day, that's a lot more volatility than we just came from. But look, I mean, I'd like to see, and it may not settle down for the next like 60 to 90 days, but if we go from 65 and it was a one and done, we're probably going to stay pretty elevated between like maybe in the 20s and 30s. So look, I'm prepared for the worst, dude. After yesterday, it's like it clearly showed some gaps in my trading that I need to tighten the hell up. And one thing I'm always trying to do is improve. So it's like I need to like be more forceful with my hedges and make sure that when an event like that, and this is what's stupid, man. There's so much good trading on a day-to-day basis, and week to weeks or months to months, that a day like yesterday, it's like, well, shit, I can never let that happen again. And I hate the fact that now in the back of my mind, it's like, I can't let that dude, I managed too much money to let that happen, to let that type of like one day, move. That's like, I'm down, 10% a day. That's ridiculous. And it's tick for tick with the markets, and I've got hedges on. So I just need to make sure that that doesn't happen.
I'll tell you something, Chris, too, just by, also doing this for better half of a decade at this point. I have been surprised many times by the market. Yesterday was also another day of learning for I think a lot of people. Unfortunately, a lot of people, blew up yesterday and they lost a lot of money, and even, talented traders can lose a lot of money in a surprise shift in the market's volatility. It is 101. We have talked about that 37,000 times on the live stream, and that might not be an exaggeration. We have talked about the idea of the VIX being low and then it shoots back up. it challenges everybody's morals. It challenges everybody's, strategies and systems. And it is very, very natural. But, one thing that I will say to people listening is that this is why over the very long term, I have trended more and more towards boring, slow and steady trading over anything else, because I want to be doing this 20 years from now. And the only way I can know that I'm going to be doing this 20 years from now is to employ so much defense in my account. I need to accept, and I'm saying this personally, I know Chris, you probably feel the same way. It is more important to employ more defensive measurements to save yourself when things go crazy than it is to try and maximize your gains when things are going easy.
Yeah, I agree. And look, we'd all love to have, the markets just be up and easy and buy the rip and sell the dip and do it every single day. But yesterday was a very harsh reality check. It really was. Things to take away from it based on today's price action. Look, we're consider it lucky that yesterday, like, did you trade actively yesterday? Did you actually start establishing some new positions? I know that you're very quick to like cut off losers and get back in where you like and give things a chance. Which is
I didn't
awesome
play it
because,
perfectly whatsoever, Chris. Unfortunately, as you can imagine, I got stopped out on the open yesterday. I joined back into my trades, but they had moved a good bit ahead of me. So again, a learning experience for me too is just, oh man, that was no fun to get stopped out, market rips. And then I still liked the trades, saw the price action on a 4-hour chart, went back in. But I did buy some things that were a little bit more aggressive. I've told you I've been more on the tech side of things. I bought semis. I put a big chunk of the account into semiconductors, which of course is ripping today. But sticking true to just what we just talked about, I am actually thinking about trimming that size just from you start looking at things differently, Chris. As soon as you have a spike in volatility and you see market downside can be so relentless, you start thinking, okay, I want stuff in my account. I do want the high growth, high potential stuff in my account, no question.
Right.
But the sizing of it is very important. So,
For sure.
your Bitcoins, your semiconductors, your tech trades, your individual stocks, you start looking at things just very differently.
Yeah. And look, let's talk short term versus long term. Okay. Short term, you can forget about yesterday. If you're a short-term trader that somehow has the luxury of not being exposed and necessarily having a portfolio, yesterday maybe didn't matter at all. Maybe it was just a good day of volatility for you. But longer term, I mean, it's a scary time and it happens. And when there's, this happened, this is the biggest move we've seen in 34 years. It's like, that's memorable. If you look back on a VIX chart and you see that, oh my gosh, this type of move happened in 2020 when the world shut down. This happened in 2008 when the financial markets are on the brink of global collapse. It's like, how is that possible? But this was just, like I said, this was festering and bubbling under the surface to have.
Can I show you something, Chris, based on what you just said? Check this out on my screen, guys. So a lot of people, a lot of different ideas floating out there. I've heard some more frustrating ones, like, for example, oh my gosh, Kamala Harris is going to be president. I'm just freaking out about, oh, Kamala Harris, that's the reason the market stops. The politic fight people, people who just like rave in comment section about politics are a different breed, man. But anyways, that I think is the smallest component. Now, jokes aside, the uncertainty about the president is probably a bearish factor for the market right now. So the uncertainty about who's going to be the president is bearish. Not oh, it's going to be bearish because it's going to be Trump, or oh, it's going to be bearish because Kamala Harris. That's not what I'm saying at all. The uncertainty of who's going to be the president, that uncertainty is something the market shies away from. It's like trying to put two positive magnets together. They don't like that.
Correct.
So, the market doesn't like that uncertainty, but that's not why the market sold off. And I don't even think that it was just the jobs data being poor on Friday. I think Friday's jobs data triggered something in the market that is scary. And it is scary for a good reason. Because if we take a look at what happened on the commitment of traders data on a week over week filing, the carry trade unwind, there was some good evidence of it happening, but a lot of people saying, oh, everybody's buying the yen. They are, but the way they're buying it is the point that you got to be careful with. They're not buying the yen because, oh, the yen looks great. They're covering yen shorts. And this was apparent in the last 2 weeks of commitment of traders data. The change in short contracts on the Japanese yen futures were just violent, but there was some buying, don't get me wrong, but it was drastically outweighed by short covering on the Japanese yen and the Swiss franc. Now, the question then becomes, is that going to morph into a sustainable market sell-off? Well, I think we have to walk backwards, Chris. We have to think, what triggered this? Okay, jobs data on Friday.
Yep.
Where's our next economic data that's going to trigger a surge in buying back? And maybe in the short run, we could see further downside volatility because there's more short covering that causes more short covering, your
Yep.
classic short squeeze.
Yep.
But for me, I think that there's enough liquidity, there's enough money in the system that could try and cover that. And this is my opinion. I could be wrong about that. But what would break that again would be a fresh round of really poor economic data to trigger more fear. But right now, we've got a little bit of a runway where the market doesn't have a bunch of new economic data in front of us, right?
Yeah, that's a good spin on what I thought was like, oh fudge, we have no real data coming in, so the market's going to be either, too much momentum has tipped it over, where now it's just like sell, 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 and get out, and it's just a flush because it perpetuates that kind of happy trigger selling,
Mhm.
or like you just said, that's a good spin on that, where maybe there's no data to lean on. And so the market's just waiting for the next catalyst, and maybe it's Jackson Hole, which is towards the end of this month. I mean, realistically, if I'm looking at the Nikkei, I said this yesterday. All my live sessions I did yesterday, I'm like, we need to see the Nikkei go up Tuesday, because
Yep.
if it goes down Tuesday, then this is going to get way worse. And if you thought Monday was bad, Tuesday could be even worse, because now you have more people like catching their breath and covering their butts and figuring out what's next, and who knows what's going to happen. But this, like, high frequency trading and algo trading, and just when like alerts and levels get triggered, there's so much liquidity that can go and snowball into these directions that it's, and I promise you this moving forward, the markets will move faster now than we ever thought. I mean, dude, I've been in this market for a long time, and yesterday was like, holy crap. And at the same time, it's like, it could have been way worse, Nick. It could have been way
Mhm.
worse. I mean, the Nikkei has dumped 27% in like 3 weeks of trading. It dumped like 20% in the last 2 trading days,
Mhm.
you know? So that's what's out there, and that's the stuff that like lingers in the background or bubbles under the surface. And so again, you talk about, I meant to bring this up earlier, 10 years out, 20 years out. There's never been a 20-year period in the history of the markets. You could have traded at the absolute top of 1928 or 1929 and still 20 years later made money. Not 100 years later, 20 years later. You could have
Mhm.
traded during World War at the top when the market, it's like all the crashes, all the worst things we've had happen. If you go to the worst possible spot 20 years later, 100% of the time you've made money. So if you have
Yeah.
that type of outlook, nothing like this really matters to a long-term investor. This is a buying opportunity for a long-term investor. Look, Nvidia may not be top 1, 2, or 3 in 5 years, right?
Yep.
Nvidia might
Yep.
fall off the face of the planet and be
Sure.
toast. Who knows? But I will say that the S&P is going to continue to push and pump and prime the top companies in the world.
Yep,
Period.
exactly.
And
And
maybe that rotation happens.
to add to your thought there, Chris, too,
Yep.
with being a long-term investor, you
Mhm.
also have to understand, not you, but to our listeners, understand what Chris is also saying. We are active traders. We're not sitting here saying, oh, we're just buying and holding. What we're pointing out, though, is that great trading and long-term investing share more similarities than differences, because
Yep.
great trading is just employing a system. Think about, like, if you were to long-term invest into a singular company, you're basically investing into their strategy. Like if you invest in Nvidia, you're saying, I believe in Nvidia's strategy for growing this business.
Mhm.
Think of your trading as an individual stock. You have a system, you have strategy. Just like a company, you have your own P&L, how much you're making, what business plan you're going to take. Same thing with trading. So even if you are a active trader, even if you're scalping the 10-second chart, having a long-term investment mentality when looking at the markets is really important. Because if you're somebody who, I can't handle a losing month, or I can't handle a couple weeks down, the markets are going to be rough for you, because that is like having a mentality where you just show up, you get paid every day. And trading is not a job. It is really truly a long-term investment.
Yeah. Interesting fact for you, Nick. This is coming from a guy that I follow there. I know you and I've talked about him. Charlie Bolello brings a lot of great factoids to the market, and he just delivers data, and I freaking love it. So Nikkei 225 declined 17.5% over 2 trading days, the largest 2-day decline in history. Again, another fantastic outlier. Like, hey, I remember Monday, August 5th. I mean, part of me thinks like, let's just talk headlines. Was this a Black Monday 2.0? Was this a Black Monday 2024 type thing?
Certainly felt
Kind of
like
feels like that,
Yeah.
right? So Nikkei down. It kind of was a taste of contagion for the day. Look, it was crazy, dude. Like, call it intuition, I guess, call it a hunch, because Friday was a pretty nasty day. Last week from Wednesday, Thursday, Friday, things changed very dramatically. So I wasn't surprised to see like Sunday's futures market rolling into Monday with a huge gap lower. Anyway, back to this. The Nikkei returns 1 year following the previous largest declines in the Nikkei. When it happened in 1987, a year later, it's up 25%. When it happened in 2008, a year later, it's up 43%. What happened in 2011? It's up 18%. That does not mean I'm calling the bottom. In fact, what I would say price action wise on the Nikkei would be, look, it's nice to see that the Nikkei was up, 10% overnight. I think that's a huge win for stabilizing the markets for right now. And as you said, if there's no major news, I call this the tuning fork, right? Where we have this type of plunge. I mean, if we take out this entire day, to me, that's a good thing. But obviously, the concern as far as price action is this now a high low, lower high to lower low to finish out this corrective move, or is this going to be, we flush down here, we go sideways, but this essentially puts in the low, and then the market maybe uses that as a double bottom, and then 12 months later, as history shows for the other 3 bad sell-offs, now this is 4. What is it 12 months from now? So I'm just curious. Like, I'm going to mark this on my chart. I'll be here a year later, I promise. One of the worst, 2-day sell-offs ever. And I'm going to say that from here, this would be one of the largest 2-day declines. Where are we? 12 months later. Okay. I'm just going to mark that on the chart and put a little box around that, because look, I did this when we started our rate cut cycle in the US, because there's a history of when the Fed starts cutting that we're usually 9 to 12% higher, and we end up being like 16% higher. So there's a reason that we look at history. There's a reason that I like as much data as I can get. There's a reason I like the Edge Finder Pro.
Yes, sir.
There you go. So I'm going to mark that on my chart just as a reference. And, look, there's a couple ways that I trade it. I'm still long the FXY, but it's mostly a hedge. It's been that way since day one. The FXY is up in position. I'm up around $4 a share.
Yep.
Big whoop. But the EWJ is a way that I can trade the Nikkei as a US trader. And it's not the same. Like this is, this is all-time highs in the EWJ. We know that this year, after a 34-year hiatus, we finally broke all-time highs again in the Nikkei 225. So it doesn't quite change the market. But what I thought was interesting on EWJ is this actually cuts out the bottom 15% of Japanese stocks.
Interesting.
So I thought that was interesting. Like, well, if you take the bottom 15% and get rid of them, how good would that be for the S&P right now? If we have a new ETF and spin off the S&P to like the S&P top 10, right? I mean, that'd be one of the best performing ETFs ever.
Yeah, it'd be a monster performer.
Yeah.
I'd be curious to see what that index would look like over a long stretch, though, because I'd be curious, because there's probably times where it, greatly underperforms.
Sure.
And then
it's still dude. It's going to be like for the last 20 years, it's going to be a tech. It's going to be a tech index, right?
Yeah.
And that's right now the biggest argument that we're seeing is tech going to be this like too expensive, rotate out? It's going to be a value play. Look, all the value investors out there, and it's interesting, man. A lot of podcasts that I consume and listen to, value investors, macro guys, and they are just underperforming year after year after year. And look, this is a competitive industry. If you're managing money, it is a competitive space. And I don't know how these guys, as value investors, can justify underperforming year after year after year. Because when they finally do better, it's not like they're doubling and tripling gains, man. It's like they're just beating the benchmarks. And so it's crazy to me that you can have this narrative of value, and just underperform.
I think if you pitch yourself, just a thought, I am no professional in the managing money space, but I imagine if you pitch yourself as a, I'm my benchmark, if you want a lower risk, money management, if you are, benchmark me against the consumer staples ETF,
There you
instead
go.
of the S&P, because this is going to produce, what is it, beta or alpha or whatever, less downside, beta,
Sure.
right? The idea being, if you invest with me, this is what we're going against. We're not going against the SPY, which has higher drawdowns.
Mhm.
Maybe this one, which has less drawdowns, this is what we're trying to beat. That's just my guess, because that's what I would think that their sales pitch would be, because value is going to beat the S&P 500, Chris, in an environment that is no fun whatsoever.
Exactly.
That's
And,
about
and
the
maybe
end point.
that's a good thing, is you can get that kind of, you can plant that seed of fear where it's like, look, if things go bad, your money is safe.
Yeah.
This is preservation of capital. I mean, I would say this, you've got the pitch against consumer staples, or you could also say risk-free rate. We outperform the risk-free rate,
Yeah.
which right now at 5.5% with zero risk in the market, that's a pretty attractive thing, considering we just had a 10% haircut, or a 18 to 19% haircut in the Nasdaq.
Yeah,
But look, like I
exactly.
said, go back to what we said earlier. 20 years from now, probably going to be fine, right?
Yep.
10 years from now, there's like an 85% chance you're going to be making money. It's like, it's so much to look at, like every 10, every 20. It just, it's been great. Let me ask you this. Um, is the stock market like the greatest financial tool ever, or is this a Ponzi scheme? And let me add to that. Think about all the forced buying that this market has every single month. Forced buying meaning pensions, 401ks, targeted funds. You have, I thought this was really interesting. So for every employee that puts themselves into a 401k plan, that is about a $17 add in to the market. For
Mm,
every employee that leaves the workforces, or takes away their 401k and pulls it, it's like a $2 withdrawal. So
mm,
you have a huge bonus, or this huge surplus of every employee that puts into a 401k forced buying to a targeted fund that's either, balance of stocks and bonds. I actually, I think I may have mentioned this on the show yesterday in a very boring way. I reallocated my entire 401k portfolio Sunday and got ready for this week. So I went a little bit more large cap quality, and I went a lot more money market, because as I can get
okay.
short term treasury still at 4.5%, almost 5%. I'm going to take that in the short term right now, and then I'll get out of that probably by the end of the year, as we start to see the rate cuts taking over and the bonds look way less attractive. But I'll get that last little bit of risk free, tame down the volatility a little bit, and my 401ks. I have one that I can't get out. I can't be self-directed. I've got one that's self-directed. I've got one that's just in targeted funds. So the one that is me not managing it, it's up like 10% for the year, which is fine, because it's kind of like a put money in it rainy day fund, but it's allocated to be, it should be fine, right? And it's
Yeah.
fine. It really hasn't any pullbacks. But anyway, point is,
Chris, my
thoughts.
wife and I, we're working towards buying a house at some point. We have this secondary account,
Yeah,
and it has been, it's our house fund account, and it's still invested in stuff. But I took the ultimate defensive approach in that account, maybe a year ago, and for the most part, in the last year, I've been like, what am I doing? This account has done nothing for me.
yeah,
What is so amazing is that in the last 1 month, that account's up like 1.5, 2%. And it's in, a good mix of bond ETFs and, dividend companies and utilities and staples. And it was just a reminder in the last few days that, diversification, which I have strayed away from in my primary trading account recently, is important, and sizing is very important. And you look at some things like, if you're looking at U.S. stocks, to your point about, is this a big Ponzi scheme? There will probably be a day where we kick ourselves for saying we should have probably had some allocation to emerging markets, or we should have had some allocation to Asian stocks, which I know you already do. But
yep,
my point is, stuff rotates in and out of this market. What is hot today may not be hot tomorrow.
yep,
Historically speaking, you mentioned earlier that maybe Nvidia's, the big stock in 5 years. Maybe it's not, but
right,
companies rotate in and out. It's personally why my sweet spot. I don't trade a lot of individual stocks. I like to trade the indices. I like to trade commodities, things that I know will still be around in 5 years. Just a personal preference, but
Yeah.
Just some good points all around. Chris, I'm gonna leave you. I gotta run to the restroom, but I'm gonna leave you to take over the stream for like 20 minutes if that's cool.
Sure. Of course.
And then just go through whatever you'd like. And thanks for the chat today. I think it lifted a lot of spirits for a lot of people.
Well, I mean, I think everybody needed it. Yesterday was no fun for anybody. And look, I mean, I think one thing that the channel needs to get credit for is just being out there and being transparent with what happens. I mean, we're traders. We show our accounts. Here, I mean, my P&L is certainly a lot more enjoyable yesterday or today than it was yesterday. I
Sure.
told you I was down about 40K yesterday. I'm up about 40K today. So for the most part, I've washed it. I'm looking to see if my P&L just continues to do its thing. I might come out okay at the end of this, and I made a gutsy play, which was I'm going to hedge heavily, and I'm going to let some of this P&L work itself out, because my expirations for some of the trades that were hurt are not that far away from being okay. Like again, you can bounce, and I can share this. I don't want to keep you if you're
Yeah,
up to
you
the
got it
eyeballs,
from
you know?
here. I'm going to leave it with you. But before I step out, guys, if you enjoyed Chris's commentary, definitely do us a big favor. Make sure to go follow Chris on his YouTube channel. We're going to drop the link to his channel. You can also, if you're watching on Twitter, his handle is @RealChrisPulver. And Chris, you got it from here. Thanks for the chat, man.
All right. Thanks, Nick.
See ya.
All right, bye. All right. So we are just sitting here doing a little spot check, and we're up 1.3% in the SPY, 1.34 SPX. Futures is actually slightly softer than that, which I think is interesting. So running all night, E-mini futures up around 1% for the S&P, NDX up 1%, Q's up 1.25, NASDAQ futures up 0.74. The Dow hanging in there, just over 1%. The Russell was down yesterday, I think 4 to 5% yesterday. Now it's up 1.3. Same thing, Russell futures, 1.24%. VIX retreating in a big way. It's down 30% today. I can't, thank the VIX enough for just, number one, like screwing with everybody yesterday and making trading pretty difficult, but just kind of falling back in line for a second. Now, I'm still a little cautious moving forward. Some of the expirations I think are most important. I take a look at my P&L right here, and I go into days to expiration. Okay. I have a trade on the Qs. I have a trade in the SPY. These are hedges for this week in case things got worse. These are roughly 10-to-1 hedges that I was willing to put up about 0.5%. So I might lose that as crap. I lost 0.5%. But to me, that 0.5% was worth the roughly 3, 4, 5% profits it would offer if things got really nasty. Crude oil futures, this expires in 9 days. This is as long as my line in the sand at 72.50. The Russell IWM is out 10 days. This one is let's see here. I've got a long call at 200, and I've got it covered out to 220. That's going to be fine. Okay, fine. Anyway, so I'm taking a look at some of this shorter duration. Some of the other trades I have in the futures market. My E-mini futures for the S&P, I have 10 days out, and I just want to give you a breakdown of this one. This is the ES feed. I'm going to go into this chart really quickly because this one might be a surprisingly good payout for me. And this is kind of one of those like tough decisions to make, but I decided I'm going to ride this thing out a little bit. And I obviously hope I'm okay. But it's this. So I started this with a bear put spread right here, which gives me about $5,000 of profit. And then I also collected additional income on this all the way down to this $5,100 level. Now, the futures market was not pleasant going from Friday to Sunday night. My stop loss I put at a 3x stop loss of my put. And when the market was getting this from the gap on Sunday, it actually blew through my level and the bid ask was way too wide. And this is what I said earlier. I've never appreciated the limit stop order until this week. And I've been doing it for years, but I've never appreciated it until this week, because had I set a market stop, I would have been blown through and probably experienced a 10x loss, because that's about the spot that I would have been filled. That's obviously, I mean, that's horrible, right? That's my trading plan is I can lose on this for a 3x stop loss, which, by the way, is still in my platform. I have it in my platform as a limit stop. So if I get stopped out, I'll take my 3x loss. And if we stay below this 55 and 54, I make $5,000 here. I lose about $2,700 here. I still make money on the trade. That's one of these trades I like, where I can put on trades, accept about a 7 to 10% pullback and drawdown, and still generate income. if none of this was happening, where it's not in this perfect little sweet spot where I'm going to make up, maybe $2,500 or so, I still make usually like $400 to $600 on these trades. So it's an income play for me that this is mostly what I make, but it's a kind of a bear trap situation in case we get pullbacks. So anyway, point is, this is not that far away. That's why I decided to kind of hold tight yesterday, and I felt like a little William Wallace action where I'm just waiting and waiting and waiting, and I let things kind of settle in. I let the bid-ask price gets a little bit tighter, but it was a wild and crazy day. Okay. Lee says there's so much summary of what happened yesterday. It all now seems a little bit clearer. I mean, I think really it's going to be a volatility event. That's really what it's going to go boil down to. But the outliers, let's just type it up for a second, and then for the time that I've left, I know that Nick and I had a great conversation, and I hope that's not lost on anybody. I mean, if all we did every day was like look at the chart, look at this, look. I think it's important to at least have an awareness. I say this: I'm a technical trader, but I am fundamentally aware. And Nick would maybe argue that he's way more fundamental than he is technical, but I mean he's got a good blend of both, and I think that's fair for every trader. There is a joke. Let me see something here. Joke between, so it's a dinner joke with fundamental and technical trader. Let me see if this will pop up. Okay, here it is. I got it. I'm going to read everybody a joke. Okay. A technical analyst and a fundamental analyst are chatting about the markets in the kitchen. Accidentally, one of them knocks a kitchen knife off the table, landing right in the fundamental analyst's foot. The fundamental analyst yells at the technician, asking him, "Why didn't you catch the knife?" And the technician says, "I don't catch falling knives." And then he turns to the fundamental analyst and says, "Why didn't you move your foot?" And the fundamental says, "I didn't think it'd go that low." So they're both wrong, right? It's funny. If you're a trader, you get it. Ha ha ha. There's your dad joke of the day. But I want to talk about, what all was kind of bubbling under the surface yesterday and how it all kind of exploded and crescendo to the upside. Okay. So we had the jobs numbers, which came out Friday for non-farm, and that uptick to 4.3% unemployment is what activated what's known as the SAHM rule, SAHM. And that is when the 3-month unemployment trend has ticked up by at least 0.5% higher than the 12-month low. All right. So that was a big trigger for the, oh my gosh, this indicator is spot on with recessions. Also, I've got another factoid here for you. Let's go into cut cycles versus forward returns. I had mentioned this earlier in the week. If we have the Fed cutting during a recession, it usually performs very poorly. Like I've got it on my phone, but basically this: if the S&P, let me type this out. Okay, so the Fed, if the Fed cuts during recession, the average S&P performance is minus 15%. Now I want to get a date on that too, because I feel like that's over maybe a 1 to several month period. If the Fed cuts during expansion, average S&P performance is plus 10%. Which side of the fence would you rather be on? Okay. Because like we've been noticing here the last couple of weeks, when things have kind of gotten heavy on the upside and toppled over a little bit, and then it kind of crescendoed yesterday, the expansion, look, I think it's going to be tough to get back to all-time highs. I personally wouldn't love necessarily seeing a V bottom. I really wouldn't want to see a V bottom. And the reason why is I don't want to see another Fed backstop, because I feel like they do it for the wrong reason. And thus far, for the last couple of years, despite this tightening cycle and despite now this potential easing cycle that we're going to go into and have some pretty decent cuts over the next 12 to 24 months, I don't like the V bottoms, because all it does is create a bigger and bigger bubble. So right now, we've seen a bit of a semiconductor bubble. We've had a tech bubble, which was deleveraged in 2022. You could call the Nikkei a bubble, because that thing dumped 27% in a much needed way. Plus, you had the Japanese yen, which has been weak for 2 years, very weak for 2 years, to 30-year extremes, and then watch it unravel in a period of 3 to 4 weeks. Not that it didn't try, right? We had a correction back in late 2022 into 2023. Then the carry trade resumed. I will say I definitely didn't time the carry trade very well because I was not thinking that within a 2-year period that this carry trade would unravel. I thought in the summertime, like why would the I was wrong. I was wrong. Now I wasn't exposed on it. I was long FXY as a just in case, and that's okay. Because that was a good trade and I'm up on the FXY, but not enough. I mean, I wasn't heavy and all in on the FXY because it's still a stock that was, $60 a share and I'm only going to buy a couple hundred shares of it. So point is, if the Fed cuts during a recession, the average S&P performance is not good. Okay. So what is, and this is the, however many trillions of dollars in the financial market, this is the $1 trillion plus question. Are we in a recession or is there still more expansion left? Okay. Either way, what we have seen the last several years, okay, since COVID, we saw a fiscal policy in the US that shows how powerful fiscal policy can be. The government was spending money. That liquidity is making its way into the markets. We have not seen central banks necessarily in the background outside of Signature Valley and Silicon Valley and First Republic and Signature Bank. Like there's like that little regional bank crisis we had. That little regional bank crisis we had in 2023. That was squashed immediately, by the way. And so it did show like another round of backstop was there, but then the Fed, M2 has gone down and the money supply has gone down. So it hasn't really been aggressive monetary policy and stimulus that way. But in fiscal side, it has been. So I do wonder if as the Fed is starting to cut and we have a pretty consistent, 25 basis points per quarter for the next couple of years, and we end up seeing, let's say 150 to 200 basis points of cuts, is that enough of a monetary easing or a less restrictive policy that still goes in tandem with fiscal policy? Because do you know that when we raise the debt ceiling, we've already seen several $1 trillion added to the debt, to the deficit? Okay. But by historical standpoint, we still have some buffer. I know that there's an argument of like, Ray Dalio and the change of world order of 120% debt to GDP. It's always a thing. Well, Japan's at freaking 200 and some percent. And I'm not saying we're going all the way to 2%. I think it's going to be a problem, but there's still room to have some type of expansion in there. And so I say this, I don't think it really matters if it's Trump or if it's Kamala Harris or whoever it is. I'm seeing, polls are reading 47 right now, whatever. It'll be a fourth quarter decision come November. But if there's fiscal stimulus still, and there's monetary policy to then ease and be less restrictive, it's still conceivable that we can have the market use this opportunity to find some lows and still find a way to justify higher highs. I'm just saying. So that's my camp. And longer term, if you're in the market for 10 or 20 years, it doesn't matter anyway. It doesn't matter. If you're in the market for 20 years, who gives a crap? You're going to make money, probably. Hopefully the market's still around in 20 years, right? Because that's the worst case scenario. If all of a sudden the financial markets implode and there's nothing left, and everything goes to zero, everybody's got problems. But if you're invested and these markets are still alive and well in 20 years, probabilities are there's going to be a way to get the cream to rise to the top and make some money in the long term. That's what's always been impressive about this, century-old game, which is if you got money to invest, you do. And if you're long term, it doesn't matter because this is a buying opportunity. Yesterday was a buying opportunity. Now I get it. We could have some structure, right? Like this is the E-mini futures. I'll take a look at some charts right now. I see a bunch of questions. Gold always. Gold. Okay. E-mini futures. We had a 1, 2, 3 correction. That was my outlook. Okay. You can go find my videos on YouTube. I posted this a couple weeks ago before this all started to topple over. I was ready for a 1, 2, 3 correction. Okay. We got it. Now, what I don't like about this is this came violently enough that it did some, I'd say, it damaged confidence in the market because this so quickly over a 3-week period, that's a big drop in an index. Okay. So what I'm going to look for is price action to support an opportunity to then resume long and also know like if I'm wrong, I got to get out and be more hedged to the downside. So that price action will be something like this. We had our vol event. We have our 1, 2, 3. We hit our symmetry and some beyond that. So I'm looking at price here. If we have this low, okay, and we have let's just say this high, this gap from last week Monday to yesterday. If price stays inside of this for the next couple of weeks, this rip isn't necessarily over, because what could happen? This market could trickle down, test the lows, maybe go back down here and test this low before we start to see, okay, where's major support? Maybe this is a 10% correction that has to get a little bit nastier and uglier and really test the conviction of, do we see oversold conditions at all? Maybe before we start to stabilize. I don't know. I don't know. Okay. So my point is, what I'm watching for price action is, are we saving the day for right now with a little bit of indecision, and we've got to be mindful of, is this a recovery? If so, look for bull flags, look for that kind of V bottom bull flag type breakout move. That's a really powerful bullish pattern in stock trading, especially if we go down, we pull back and we just drift like this, or drift sideways and we break these structure lows. That low could be tested very quickly. So I'm going to say this. I know it shouldn't be so interrelated or correlated, but I will be watching the Nikkei way more closely, because I do think that what happens in Japan right now is going to automatically be a risk on or risk off feeder into the US markets. Just saying. Okay. So that's my thoughts. I think, today feels a heck of a lot better. SPY is, trying to work its way up and close the gaps here. Q, same type of thing. We're having the opening day breakout. We're looking to fill this gap around this 447 area. It's okay, but you got to wonder, just on the technical side, if we come back to this level right here, or we come back to this level right here and close the gap, is this going to be turning aggressively by the end of the week? Today's only Tuesday. The week is not done. After having this vol event, are we about to just see this, the bears kind of rip through the market again? And if so, I'll be watching for that. If not, then I want to see price safely not only fill this gap right here, but also start gunning for this gap around this 455 and 456 level. If the bulls can come this way, where we go low to high, and stabilize in here, if that gap is filled, then I think we're putting a bit more of a bottom in, and then I'd be looking for trend line breaks, and longer term, looking for upside. And again, my analysis can change, right? But point is, that's what I'm looking at here in the near term. Okay, Russell, we're up a little bit off the lows. I've got some positions on the RUT and let me go to this chart here. And I'm just going to do this macro stuff. So let me run through the charts. I'm going to catch a lot of those requests you guys have. So type them in if you want to. I'll take them. I'll read them. I see the comments. But for me, the IWM, 205 and change. I think it's nice that we're stabilizing here. The trades that I'm more interested in right now, the 2050 and 2100, these are pin prices for my Russell trades. If we can get back to 2050 or 2100, let me check on one thing very quickly. I think this is an RUT trade. Oops. RUT trade right here. Let's go symbol. Okay, so RTY, that one's down a little bit lower. The RUT is down here. Okay, so I have the 20. Where's my pin price? So this expires. Okay, so the 23rd and 30th. So I got a little bit more time in these trades. Ideally, these are broken wing butterflies. And if I get these in my profit trap, it pays like 10 to 1. So my max risk is around like $700. My max profit's around $7,000. And I hope it stays in like the perfect level, but it's hard to get. You got to pin it pretty much at the price at expiration. That's slim to none. But the days leading up to that final expiration on the 23rd or the 30th, that could work out to be a pretty good trade overall. So I'll be watching those prices there. The RTY, this one's a little bit further out. I think this one's relatively safe going out to next Friday, probably for just the tail credit, which is going to be $1.15. The VIX, like I said, we're retreating nicely, which I'm happy with. I call this the tuning fork, right? So if we have the low, the high, and we have this huge candle that probably just settles in like this, okay, I just see elevated, okay? Not necessarily, hey, we're coming back up to 60 again. Maybe something could trigger that, but I think that the whirlwind of news that we had from the Fed to the SOM rule being activated with non-farm payroll to Nikkei crashing the way that it did, I just see volatility as this. Yeah, look, believe me, yesterday I was like, please don't go to 85. Because I mean, I don't know. I don't know what it would look like if it went to 85, but that was one of the biggest moves that we've ever had in the VIX. So I could see the VIX staying relatively elevated around 20 plus. I think that's okay. There's going to be good opportunities for selling options. The biggest thing that you have to have is you got to have dry powder. You got to have some buying power, and there's things to deploy and things to actively trade. So that's a good thing. But I'll be watching this very closely. as you should. I don't think we're all of a sudden just reverting and coming all the way back down. I looked at trying to short the VIX yesterday. It was impossible. If I wanted to short it, I was looking at like a $55 long put. It was going to cost me $30 to trade it. It's ridiculous. Now, granted, like the options chain, if I went out 5 days or whatever, it's like, sure, it would be up in profit today. The deltas would have switched in my favor. But the point is, it was so expensive just to get break even or better that you needed the intrinsic value to go your way, as in addition to the extrinsic value to be it was a crappy trade. So what I did instead, this is a way that I traded the VIX. I put in a put on the SPXY. So I actually put in a naked put. I have a naked put at 35. And I think I collected yesterday on that one. Let me check, and then I'll get to I'll just keep going with the requests and the symbols here before I wrap things up in a few minutes. Let me go SVXY here. SVXY, I collected $3.05 yesterday. So I'll just put here 2.90 to 3.05 for my accounts. It just depended on the fill. But a $35 put is right there. It's cash secured. This is a good way to short the VIX with also kind of trading it like an index and trading it bullish versus having all the crazy volatility that we saw yesterday. So a little bit more realistic. My pending buy yesterday, I'll still be interested in taking some shares, but most likely I'm just going to keep the naked put, not worry about it. I think that's a good spot to generate some income. Okay. All right. Back to the charts here. Dollar index. I like this dollar index below 103.90. I've been looking at this and waiting for this patiently for weeks and months. We're safely below this level. I'd like to see the dollar show some pullback here and then look for another leg lower. I think dollar weakness makes a lot of sense. 101, okay, 100 would be an awesome route on the dollar. How do we get that? We get that with a market that's stable, okay? If we see more selling in the S&P, more selling in the NASDAQ, more selling in the Nikkei, more selling in the DAX and the FTSE and all these international markets, more selling is not going to be weaker dollar. I'm sorry. It's probably going to be a stronger dollar with the stronger yen, with the stronger Swiss. It's going to be a risk-off trade and tone to the market. So for me, if we see stability in the stock markets, that's a good thing. And then the dollar can start getting weaker because they're going to price in the rate cuts. So that buy the rumor, sell the news of the dollar, the story to me is as long as we stay below 104, I am right now only looking for sell opportunities against the dollar. So Aussie dollar, I'm looking long. Euro dollar, looking long. Pound dollar, not my favorite, to be honest. I'm going to cancel the pound dollar for right now. New Zealand dollar long. Dollar CAD short. Dollar Swiss, I'm long with a carry trade, but I'm stupid because I'm holding that thing. And then dollar yen is done. It's toast. It's done. 162 down to 140. You're freaking out. Like, if you made money on the deleveraging and the unwinding, awesome, congratulations. I'm not touching the yen pairs for a little bit. Okay, basically my hedge the last several weeks was dollar yen long, euro yen long, pound yen short, 200 pips by 100 pips, lose one, win one, make money. That's all I did for the last several weeks. My only yen exposure were basically pairs trades. I don't trust the yen to be like full on basket trading, so I didn't. But I still made some money on the way down. But that's it. Okay. All right. Okay, that's that. So that's dollar. U.S. oil. We're holding this like $72.50 to $73 level pretty firmly. I get it. I'm surprised that oil hasn't had more reaction. I mean, we got some pretty heavy conflict going in the Middle East right now. But the U.S. is producing oil to record scale. I mean, natural gas in U.S. Production is super, super high. OPEC, obviously plays the game of supply and demand, and they try to say they're going to cut, or they can always cut. It's summer. There's still oil demand. It's been slower because of China being mostly offline and not really coming back in the type of rounds of stimulus. So oil, I mean, I look at it like it's sideways. I mean, if it's sideways, great. We can hold this level here. We can hold this level here. And I just want to see if oil will just like stay in the middle. I personally, it's like I've got some exposure on oil. I don't want it to get below 72.50. If it does, I'll take a small loss in a credit spread. No big deal. Right. But so far it seems to be holding okay. If we come back up into this recent pullback at 77.78, that's not a bad sign. Oil futures here, there's CL. Natural gas futures. I'm going to actually take a look at this right now. I think the timing of it is kind of crappy. I don't know what I can get for natural gas futures at like the 1.6. Let me look at the futures feed. So if I go / NG, okay, And let me take a trade. Now, my bet would be that natural gas is going to stay above 1.60. Okay, that'll be my line in the sand. How about I go out nat gas futures? Could I go to summer of next year? Sure, maybe. So that's a long ways out. That's essentially like doing a leap almost on nat gas futures. Right now, the nat gas futures. So we're trading at 202 to those forward contracts. I mean, my price is I want this to go down to 1.6. So if I stay out of the way here, okay, I can make $40 and risk $460 with a 70% probability. That's a terrible trade. So I'm not going to take it. I mean, that's like, I'm not going to take it, period. Now, if nat gas comes back down, okay, comes back down to these lows, I'm way more interested in at the monies or out of the monies and looking more longer term there. Natural gas has been the widowmaker along with the Japanese yen. So I'm not trading it right now, but I'm interested in watching some of these lows. Gold, pay attention. Everybody's favorite, of course. Look, gold longer term, I'm a bull on gold. I think we're in the perfect environment right now for the next 6 to 12 months to see that there's some uncertainty out there. Okay. But rates are coming down and there's probably going to be some more liquidity and stimulus added into the markets. Unfortunately, this world is fueled by debt. And at some point, the debt bubble maybe bursts. But until it does, I mean, gold is always out there as like a wise hedge. And short term, I still think gold, even if it's range bound, look, if anybody sees a breakout here, okay, gold to the upside is a awesome trade. What we don't have yet is confirmation, right? So what I'm looking at here is if we are using this level and it's a bit of a broadening pattern, which I've talked about for the last several months, this is some indecision that we're going to have to navigate with gold. But if you have an opportunity to either see a pullback here that stabilizes, okay, or a pullback here, which I think is probably the better technical trade. If we pulled back here, I would look for this as a bear trap opportunity. Now, there's two ways to trade this. Either one, I just buy the level and hope it bounces. Or two, you buy the level. If it dips lower, you give it one more chance to see if it rips back up and then buy it again. And then you're long with your stop loss below the U-turn. And that's a bear trap. And you take that bear trap and you run with the upside. That would be my preferred way to trade gold. If I get a chance to trade at 2270 or into this like bear trap zone at 2250, I like that trade with a tight stop. I'm long GLD right here at these lows. I haven't added anything to it. If gold comes back down to this level, which would be about 212 on GLD, I'll probably buy more shares of GLD. I'm also long on gold futures with credit spread stop losses below that support. Okay. So, the highs right here, 2484. So set a chart alarm. I'm just going to set one right now, all-time highs. It's great. If we hit all-time highs, awesome. It's one of those trades where I think this trend is pretty solid. I think the structure is great. There's a lot of support right here. So if it is going to pull back into an attractive zone, that's a great spot to be looking to get long. Okay. The next spot, which is less favorable because it's buying the highs, but that momentum could still be there with a break, retest, and go. And then you're just looking for a good structure to stay with the trend. $3,000 right now doesn't seem like a bad spot. Longer term, who knows? I also wonder, like, if gold is ripping to the upside, is Bitcoin correlating with it at all? Look, if here's another thing. If the dollar drops, okay, the dollar dropping could be a great way to finish the year for a lot of traders. If the dollar gets weaker, so I'll put USD here. If the dollar gets weaker, we could see gold up. Okay, so I'll put gold up. We could see Bitcoin recover. Okay, Bitcoin, Ethereum, crypto in general. We could see oil up, right? We could see the markets. So let's just say stocks up, right? We could see bonds, maybe. This is gonna. I mean, bonds kind of front run the yields, but bonds might be up with a bit of the safe haven play, but we'd see yields down, and just do the inverse, right? So I do think there's a lot riding on this for the second half of the year. If the markets, if we're going to see all-time highs by the end of the year, which seems like a tall order right now, if we're going to see all-time highs by the end of the year, the dollar, in my opinion, has to be weaker. Has to be weaker. If the dollar is stable or resilient or stronger, I don't think there's any way that we see all-time highs by the end of the year or even going into 2025. I think we're months and months, maybe years away from all-time highs again if the dollar is going to get stronger and see this big risk-off tone to the market. So just my thoughts. Okay. What happens to gold when uncertainty of war? I mean, look back to 1940s and see what happened to gold during wars. What happened in the 90s when we were in the Persian Gulf? What happened during 9/11? I mean, gold's always seen as this safe haven, always. So, I mean, look, I'm never all in on anything. In fact, I had a really interesting session this morning with my trading battle that I hosted. I talked to two traders that are essentially short-term day traders. And so, I mean, I look at my portfolio and I'm laughing about like, okay, this is my portfolio, and it's a lot. It's a lot to review. It's a lot to handle. It's a lot, but that's what I do. I know that if something's up, there might be something down, but there's a plan to everything that I do. And what's nice is even through times of uncertainty like yesterday, I still have trades that are paying out profit. It's a matter of, do I want to take profit, manage it, wash the bad trades? I mean, maybe that's why I do it, because typically there's always something that can keep generating higher watermarks for me. So, but it's not easy. I mean, I wish I was just like, yep, all I do is trade one thing for 15 minutes a day and that's it. I'm done. That'd make my life a lot easier, but maybe I like this stuff too much. I can talk about these markets all the time, as I typically do. So yeah, I like it a lot. And that doesn't matter. At the end of the day, it's like, am I making money? And yeah, it's not that hard to make money when you have a good core strategy that you generate income and plan for the best, prepare for the worst. Sounds cliche, but it's true. Yesterday was the worst. Yesterday was an outlier type day that it will change people's trading plans forevermore. I watched it all day yesterday on a variety of Discord channels and Telegram services that oh my gosh, my so look, real quick. I mean, if A1 team's cool with it, I'm going to give a shout out to A1 Trading for being live yesterday and running what was a very important and necessary session. I know we had a lot of views yesterday, which was great. And why? Because everyone wanted to know like what the hell is going on, right? I'm a big fan of the Tasty Live Network as well. I work closely with the Tasty Trade team, and they've been my broker that I've been able to park some capital with and trade with for the last couple of years, which I'm happy with. My point is, they canceled all of their traditional daily segments, and they just let two veterans sit in the chair and take on callers and just answer questions. So yeah, Tom Sosnoff and Tony Batista that have been in the pits in the markets for 40 years. And they were just like, this is what I like. This is what we'll do. And, there's a lot of intelligent traders out there. But when a person calls in and says, hey guys, really appreciate it. I got a $150,000 account today. Opened up. I'm down 130 grand. That was the tone yesterday. That's how bad it was, whether you realize it or not. And I say this is my life's motto. Okay. It could always be worse. So if that wasn't you yesterday, consider yourself lucky, because it could be worse. And I know that I'm fortunate, like right now, and I'm not out of the woods. Today's P&L, okay, fine. Yesterday's P&L sucked. Today I'm kind of washing it back out. That's okay. But I'm not happy yet. I'm not done with these trades. I need to get through, mostly August and September to make sure it's like, okay, now we got the second half plan. Let's see what happens post Fed rate cut. Then we've got the election drama in Q4 and all this other stuff, right? So never a dull moment. All right, everybody. If that's it for the day, if I'm the last guest, I'll wrap things up there. I did a little bit of everything. Gold, like I said, long term, I like it. I'd like to buy that 2270 level. Silver, I'm still pretty bullish on silver. I do own shares of SLV. My break even on SLV is around $24 right now. Let me double check that. I will see if I'm up P&L wise on SLV. I've had some good profit on the year. I'm up $27,000 on silver this year, and I'm still holding some SLVs. And then I have some SI futures trades, which are out for the next 21 and 50 days that I'm going to keep monitoring until expiration. Bitcoin, nice little rip off the lows. We were sub 50 yesterday at 49.6 for a quick moment. Again, same thing on Bitcoin. I'd like to see if price will, maybe it's something like this. Okay. I'd like to see price maybe give us like a bull flag opportunity to see if there's a buying opportunity there to buy. Or, what typically happens is we have a high low. If it settles back in for some type of falling wedge, then look for this thing to confirm and look for more upside. Again, if the dollar gets weaker, that's Bitcoin's hope for the next, 6 to 12 months, in my opinion. Okay. Nimmer, yeah, I get it, man. Loss of money, but not major. Yep. It could have been way worse. Okay. Could have been way worse. All right. What else? Copper. Copper's still plugging away. Nikkei with a big rip to the upside to kind of wash away some of the pain from yesterday. Let's see. The DAX is stabilizing. The FTSE stabilizing. China market stabilizing. Brazil. Somebody brought this up in my trading room yesterday. Brazil. I'm going to be watching this as an emerging market play. I think there's pretty good structure in here, but I will actually. You know what? I don't mind taking some exposure here. I mean, I'll probably just do like a cash secured put. It'd be like level 1, level 2, and then have some emerging market exposure, which I don't mind doing like a 1 or 2%er. I think that's okay. This is a fairly non-correlated. The problem is if we have a downturn in the markets, Brazil will suffer. All emerging markets will suffer. If we have a milkshake theory thing where the dollar gets stronger and the risk-off trading happens, we'll see some nasty moves on non-US based trades and the dollar getting stronger. But I don't think the dollar's necessarily getting stronger right now. We've got, let's see here. Indexes rebalance quarterly. All right. So anyway, that's Brazil. Anything else? Mag 7s. Apple, kind of a single day buying opportunity, but it's faded a little bit. I mean, we were down to 196. I had a lot of ratio spreads get tested yesterday. Amazon after and again, is it a bit of an overreaction to have like, a 0.4% revenue miss when this is still, fairly solid as far as earnings and revenue? It's like, dude, the company is making $148 billion a quarter, but I guess that's not enough. They should fire their forecaster. I still like Amazon at this level. Amazon to me is one of my stash away stocks. I just want to own it. I want a dollar cost average into it. I think if you give, Apple enough time, Microsoft enough time, Google enough time, Amazon enough time, these will all be $1,000 stocks and they'll split later. But you got to stay in the game for a while. Maybe it's 5 or 10 years out. But to me, look, if you go up, let's say 5x, okay? If you go up 5x in a 10-year period, that's a pretty good return. If you annualize that, that's a pretty good return. You're beating the benchmark by a landslide, But are you all in on Amazon? Probably not. But I do think that it's still a good stock. Is there competition? Yeah, you've got your Temus and your Sheins and other like Chinese retailers that maybe add some competition. I own stock with JD. That's a Chinese retailer. Google pulling back into some what I think is fairly attractive levels. We got solid trend line support in here. Looking for the upside if we hold that 150 handle. We have the antitrust stuff that hit Google yesterday as well. Meta sideways. Microsoft, a decent little pullback. I'd prefer to see something like a bottoming pattern before I get long Microsoft, because to me, this looks a little toppy, right? Could this be a topping pattern? Yeah, it could be, especially on the right-hand side of the trend line. Microsoft could be in for a bigger, this exponential run to the upside, 1, 2, 3, and then we're talking about bigger discounts on Microsoft to buy. So I'll probably stay out of the stock. It's a little bit more expensive. That's all. Okay, Netflix, fine for right now. NVIDIA, big pullback, ridiculous amount of volume and market cap moving all over the place. I mean, this thing dropped like 40%. Is that right? 35% for one of the top 3 companies in the world. That's an incredible amount of volatility on a big, big, big stock. But where are my trades at? Here's my NVIDIA plays. I don't own the stock yet, but I'm trying to. So let me look at a couple of plays here. So I'm up like $3,700 on a video right now. Looking at an individual stock. These are just wide credit spreads. So 75 by 55 generates some income. I did, let's see here. That was an earnings play. I did a $12.99, made $15. That was a little profit. 241 credit. So that's 400, almost $500 right there. So anyway, I'm just trying to generate some income on NVIDIA. I think I will do this now. I might look at a ratio spread. Yeah, I'll do that. I'll do a ratio spread in NVIDIA and see if I can get something where if I want to own it, I'm going to own it cheap. I love the $90 zone, and I am obsessed with something at like $75. So I might put a ratio spread at like the 80 by 75 or something like that. See if I take some shares, it's going to be in maybe the $70 break evens. Tesla hanging in there. I have a ratio spread on Tesla. I need to see it stay above $200. If not, I'm willing to take the assignment. If things calm down, I'll probably do some very aggressive covered calls and wheel strategies on Tesla to get out of it for a couple of bucks. And then we've got the bond situation, 3-year, 2-year, 10-year. So the 2 years back up by about 0.1%, 1.12% higher. So the inversion that triggered yesterday back to the normal yield curve where the 10 and 2 is no longer inverted. We're still slightly inverted. And then we're way off from the 3-month 10-year still by almost 130, 140 basis points. But just watching. Okay. All right. That's it for me today. Thanks a lot for being with us. Come back and join us later. Equities on Demand students, pop in the trading room in about 10 minutes. I'll see you soon. All right. Thanks, everybody. Take care. Talk to you soon. Bye.
Thanks for tuning in to today's A1 Trading Show. Make sure to subscribe and to turn on post notifications so you don't miss the next one. Also, we're looking for more guests to come on the show. If you're comfortable being on camera, have trading experience, and you're looking to grow your audience exposure, we'd love to have you on. In the live stream chat and description below, we'll drop a link to apply to be a live stream guest and join in on the conversation. We hope to have you on soon. That's all for today. Trade safe, and we'll see you next time.